Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with Deven Soni, who's the co-founder at Kingmakers Ops. I'm a big fan of investing in already established service businesses. I've been talking about this with a number of friends for a while now, and Kingmakers Ops is doing just this. They acquire, systematize, and grow residential service businesses. As a company, they're looking to become an operating holding company of a number of about a $1 million EBITDA, HVAC, and plumbing businesses. Boring businesses are actually quite exciting, and the thought of acquiring and operating a portfolio of these stable, downturn resilient service businesses, I really like it. So why now? Did you know that an estimated 60% of small business owners are looking to retire in the next 10 years? So there are definitely opportunities if you look in the right places. We talk about investing in private service businesses overall, how to find deal flow, valuations and multiples, and then how to systemize and grow once you've purchased them. And then for Kingmakers Ops, obviously an exit strategy. So what do they want to do with these companies after they've held them for a number of years? You can see all about them at kingmakers.co. Also, don't forget to subscribe to our podcast. You can find it anywhere you digest your podcasts or on YouTube, and this really, really helps. There you go. Please enjoy this conversation with Deven Soni of Kingmakers. Morning, everybody. I am here with Deven Soni, who's the co-founder of Kingmakers Ops, which owns and operates a portfolio of small residential businesses. Welcome, Deven.
Thanks for having me.
Yeah, absolutely. Thanks in this COVID time, taking some time, jumping on in these calls. So I appreciate it. So absolutely. I wanted to start just a little background, who you are and a little bit more about your company.
Sure. So my name's Deven. I'm here in the San Francisco Bay Area. And, I'd always kind of been a finance nerd. So, one of those kids that read, Warren Buffett books when they were 12 years old, and went to UC Berkeley here in the Bay Area to study finance. Always thought I wanted to be an investment banker. Ended up getting, working investment banking, helping companies like Amazon and Google and Microsoft do M&A. Really enjoyed that, but I kind of just felt more of an attachment to, wanting to be closer to businesses long-term versus being really transactional, like bankers often are. So eventually moved into private equity at a bigger firm at Goldman Sachs, where basically I helped Goldman make purchases of businesses and investments directly off their balance sheet. So they had about $6 billion allocated to technology investments, and I helped invest in everything from early stage software companies all the way to buyouts of semiconductor companies and things like that. And it was awesome. It got a really good perspective of kind of the entire investing landscape. And it had a lot of success to the point where they increased their allocation on their balance sheet from like $6 billion to like $20 billion, which basically meant that they could only really invest in really, really big deals. You have to buy a big public company, otherwise the math doesn't work on returns.
Oh yeah.
And I at the same time, while they were gravitating big, I was kind of gravitating small, I guess, where I just kind of really like the value in smaller businesses. And I think what can often happen in private equity is they've had really good returns historically, and because of that, there's been a lot of money flowing into the space. And because there's a lot of money flowing into the space, there's just a lot of competition because there's not so many businesses out there that meet that criteria of profitable large business at reasonable valuations. So the valuations keep going up and up and up, and it turns into less of a kind of a value play anymore, which kind of, again, me being a Warren Buffett nerd, kind of shied away from. So eventually I decided to kind of branch on my own, and noticed while in the technology world that there was a ton of small, unloved, digital businesses. So, think small software companies and small tools that people use, blogs about, nearly anything. And those were all kind of there. And this is, 2014, 2015, where there wasn't a very active market for these things, and they were very, very affordable. So whereas, at Goldman, we were often buying things at, 10, 12, 15 times EBITDA. And I was like, oh, that is a great bargain. I was looking at things at like 1 or 2 times EBITDA, and I was like, holy cow, what is this stuff? So,
gobble them up, huh?
Yeah, exactly. So you figured, let's try it out. So, ended up partnering with my current partner, also in Kingmakers, and we started buying, digital businesses. So mostly in the software as a service space. So we bought between 20, and we kind of the analogy I like to use is we're kind of like the fat kid at the buffet where, we're like, okay, this looks delicious. Let's just pile of plates. We bought a lot of everything. We bought things in the SaaS space. We bought things in the services space. We bought things in, kind of advertising driven affiliate, like almost every niche we could. And we had a lot of success with that. We, returned, 30% plus a year to our investors that we kind of raised capital from. But operationally, it was a bit of a nightmare because it's really hard to systematize a ton of businesses or operate them in a functional way when each one has a different business model.
So you were actually owning and operating all of these businesses.
Mm-hmm.
Oh wow!
Right. So they were too small. Usually when like a large private equity firm will buy a business, it's they buy a business that already has a CEO and a CFO in place. Here, you maybe have a customer service rep and a writer and a developer, but you don't really have a management team. Like the owner is a management team. So what we really had to do was build a systematic way to replace the manager or turn that manager role into something that can be broken up into little pieces and kind of fragmented. So that's kind of a lot of what we did. What was really find people that could run the business or run a division across multiple businesses like ad sales or something like that, and then really try to kind of streamline stuff. Which again, great in theory and in practice. When you have a lot of disparate things, it's not the easiest thing in the world. So there was a lot of operational overhead, meaning we drove great returns, but there was a lot of white hair and hair pulling associated with driving those great returns.
Oh, absolutely. I worked in a very similar structure, the operational holding company, and I mean, 90 plus legal entities, all in their own little ball games. It's and you just end up layering on management and reporting. Gets a little messy. So how long were you doing that with your partner, and did that evolve into Kingmakers Ops, or how did you get to where you are now?
Exactly. So that fund was called Wired Investors, and we ran it pretty actively from 2015 to about 2018, and we stopped making acquisitions in 2018. And I think the things that changed in 2018 were one, I think that little secret we had of these digital businesses kind of got discovered a bit. And the valuations kind of went up dramatically, where things we were buying for 1 or 2 times EBITDA, we're now expensive at like 4.5 times, which is kind of the market rate now. And I think the second thing we learned was that these digital companies they have their own their own risks, and we actually felt like 3 times EBITDA after having a whole 5 years of owning these things was actually like a pretty fair price, because there's a lot of platform risk. Google can shut you down one day, Facebook can shut you down one day, Amazon, like these companies are all encompassing, and you don't have a lot of leverage as a digital business. So we felt that the fair valuations were what we were paying last year, not what the prices were this year. And then secondly, there's so many like disparate niches, right? Like it's great in theory to go say I'm going to roll up 7 dog blogs, right? But it's another thing to say we're going to find 7 dog blogs to roll up that are actually for sale and well run and the right price. So at the same time, we were kind of figuring out what's next. And I think we've done really good at building the systems. We've done great at building systematic ways to do digital marketing across the portfolio and had a lot of success there. But we kind of wanted to be able to do it in a space that was more appropriate for more of a roll up where we could own a lot of companies in the same space. And that's kind of where we started with kind of the idea of Kingmakers Ops, where and Kingmakers, where we basically just holistically said look, let's actually look at all the industries in the U.S. or that are out there, and let's figure out what ones that could make sense here. And we looked at everything from the data that the Small Business Administration, the U.S. publishes, which is how many businesses exist in a space, how many are funded every year, what are default rates, what are loan default rates by industry and things like that, and said, look, we want to find industries that have a lot of companies, very few loan defaults, meaning they don't go out of business when markets get tough. And then holistically beyond that, me being a technology nerd was like, okay, well, let's find industries that aren't going to get changed by Amazon and aren't going to get taken over by the machines, right? Like in 5 or 10 years, trucking may not be a great idea if they're all driving themselves, et cetera. So, we kind of holistically fell into residential home services, which I just kind of define as businesses like roofing, like plumbing, like HVAC, like water damage restoration, just things like that. That the concept is you have a problem, you find someone to solve the problem, usually online. Someone comes to your home, fixes your problem and charges you, right? And maybe if you have the problem again, they call you back, or maybe there's a maintenance plan or something like that.
That is a very different business model than buying online businesses. I mean, you said it correctly, like the platform risk, a lot of these lead gen or whatever, if Google changes their algorithm, it just completely torpedoes your business model. So I can see how you wanted something a little bit more resilient, and go into these home services. So it sounds like you did a lot of work, a lot of legwork to arrive at this decision within home services. So I'm curious if you could expand on that. You did a little bit, but what were the other contenders that you were looking at? And then do you have a regional focus with these home services, or it's kind of all across the US?
Absolutely. So, the other data points that we really used were, okay, like what, we kind of wanted to figure out, we were very like honest with ourselves and said, what are we actually good at? We're very good at, digital marketing to consumers. That's kind of all we did with these businesses, with the digital businesses, right? It was more B2C or B2SMB. So you said, what are businesses that can be grown very well with digital marketing? Second thing was we wanted something that could be rolled up. So, what are industries that have, more than 10 or 20,000 businesses? And then you kind of force rank those, right? And you look at HVAC, which has, 120,000 HVAC companies in America, or you look at, roofing, which has 25,000 plus, and those were very appealing versus saying, oh, I could totally grow a brewery or a fish farming operation, right? But there's like 9 of those, so it's like, okay, well, that's going to be a little difficult to roll up. So that was another consideration. A lot of the industries we kind of wanted high-ish operating margins. So which means the more revenue you have, the more goes to the bottom line. And if you look at something like food, with like 5 or 10% margins, or you look at something it's highly regulated, like payment processing, often like 2-3% margins. So we really liked the 30% margins you can get in HVAC, or the 40% margins you can get in roofing, because that just means that more dollars flow to the bottom line from the success you have in growth. So that was another reason. And we looked at a lot of spaces, like like other things like tax preparation and CPA firms and things like that were all very interesting. But we just also felt that the churn on those businesses was a little kind of stranger. Like you really need to manage customer service very heavily, like over the life of someone, even though they may pay you just like once a year. So we kind of liked that the transactional businesses a little more, just because you always know that no matter what happens, there's going to be a water heater leak or a air conditioner blowing out and things like that. So again, maybe just being a little shy from digital, where your business can disappear overnight. We sort of felt like these businesses are not going to disappear overnight, so that the effort and care you put into hiring good people and building systems is not going to go to waste.
Absolutely. And I think after working in technology for so long, you realize how fickle some of these things are. And I have some friends that are serial entrepreneurs, always turning up new online businesses. And now they're like, I just want out. I want to like operate a cafe on the corner and give back to my local community. And I know it's not scalable and I'm not going to make a ton of money, but I want something tangible, right? So I get it. So these residential services, it sounds fascinating. I mean, how much work you were doing to arrive at this niche. But so I didn't hear if you're focusing globally, US only, nationwide.
Yeah. So maybe it might make sense here just to kind of touch on the 2 business models we have, because I think they're a little different in how we think about it. So we started Kingmakers Inc, and which is basically a company that actually is a bit more of a passive investor, meaning we actually find companies that we think are really good businesses, and for that it doesn't really matter where they are. So it could be in New York or California, and we say, hey, this is a great home service business that we would love to own or invest in, and we think it's at a fair valuation. Let's actually partner with someone who is kind of keen on running the day-to-day, so that they have skin in the game, and then we have someone who's high quality, high caliber, kind of owner who can think about the business in the shower, right? Because like if we own 300 of the things, we can't think about 300 companies in the shower, and there's always local nuance with any business. So what we with Kingmakers Inc, it was basically, let's find these businesses, let's use the same systems we use to source, to grow, to automate, and open it up. Almost like Amazon Web Services opened up their own infrastructure. We kind of wanted to open up our infrastructure to primary owners and kind of give them the confidence, because we think like buying a business is a fantastic career choice, like you said, for someone that just kind of wants to get out the hamster wheel of corporate America, or the hamster wheel of startups or venture capital. This is a great way, and you actually can like do quite well financially, right, in some of these businesses. Many people are making 7 figures a year in, just by owning these things, right? And it's really easy to finance them, so there's like a lot of benefits. So we said
the more boring, the better. I'm a big
exactly
fan.
Right. Yeah, the more boring, the less competition often, right? So we were shouting from the rooftops, like we did this analysis, and like these things are amazing, like more people should want to do this, right? So that we created Kingmakers Inc. to basically open up our infrastructure to make it easier and give more confidence to people that want to be an owner in businesses. And our business model there is we co-invest with in business, similar to maybe an incubator accelerator would invest in the business in exchange, kind of provide like infrastructure and services and knowledge and experience.
Gotcha. And is Kingmakers Inc. Structured as an investment vehicle? I mean, this is a fund that's open to.
It's a holding company, so it's kind of structured more like a Berkshire Hathaway style entity, or one of these like long-term holding companies. We can get into the nuance of taxes, but basically since 2018, it makes a lot of sense to do C corporations for almost anything, and that's why we're a C corporation. So we are open to accepting some capital there, and we have a round open. But it's kind of like a regular startup. There's a pre-money, and then we take in money and have a valuation, and the goal is to pay out some dividends, do roll-ups, and eventually hopefully take the thing public.
Okay, awesome. So Kingmakers Inc. is this passive investment vehicle holding company of a number of different businesses. Doesn't specifically have to be residential. You probably still have some SaaS companies in there, or that's completely with Wired.
Exactly right. So there's a lot of different types of businesses. We've kind of zeroed in on home services as that first niche that we really like, and we've kind of built a lot of infrastructure for it. But we continually sort of expand on the infrastructure we're building to make it more relevant for different types of businesses, right? And some stuff is like how to hire a great manager, how to set up your website to be locally optimized. All those things are very extensible across many businesses.
Absolutely. I mean, how can you drive traffic to it? Yeah, it works for most things, right? Okay, so that's Kingmakers Inc. And then Kingmakers Ops is more, we're going to wholly own this thing. We're going to drop in our management team, drive for synergies, roll it up into divisions, into this Kingmakers Ops operational holding company.
Exactly. So, I think with Kingmakers Ops, what we realized, especially kind of in this, kind of post-COVID world, we found a few things. One, I think a lot of business owners were really leading with fear, if that makes sense. They, this happened and everyone just kind of froze up all of a sudden, and they weren't, many people weren't investing in the business at the level that they should have, seeing the returns in the business. They weren't, being aggressive in hiring and adding new people when everyone else was letting people off, right? So I think it's natural. It's not like criticism. It's just like people, when there's change, you tend to kind of freeze up a little bit. And at the same time, we were sort of here like watching our systems and saying, look, it just got 80% cheaper to advertise on Facebook. It got dramatically cheaper to advertise on Yelp, like because everyone turned the first thing you do when you get scared about the future is you try to cut all your variable costs, and advertising is like a variable cost, and people just like froze it, right? And all of a sudden that means all this inventory was there. And we were like, this is ridiculous. Someone needs to do something about this. And, even the business that we had kind of partnered with people on, oftentimes they had a very similar mentality, which is, we're just going to sit this out and see what happens. And we were like, on the pavement being like, this is like the best opportunity to be really aggressive. And that kind of accelerated our desire to really own our own portfolio, so we could, kind of eat our own dog food, and actually show that what we kind of say makes sense actually makes sense. And, just how, McDonald's is an example, right? As an organization is primarily a franchised organization, but they have, many of their own wholly owned stores because they want to use those as test beds for their experiments to see what's going to work well and what's not. We created Kingmakers Ops, one as a test bed for us to really kind of, use all of our systems aggressively, be very diligent and experimentative with how to kind of grow these types of companies. Secondly, obviously, I think we do think it's a great business decision for us, and the returns are fantastic, and we are having a lot of stuff growth. So like that's it has to be a strong business decision. But I think those two things kind of really marry together into our reasoning for kind of doing our own portfolio companies that we own and operate.
Yeah, that makes sense. I mean, So I'm curious, on your website or on the WeFunder, it said you had a proprietary sourcing and deal scoring system.
Yep.
So obviously this is proprietary, but deal flow is a very important part of this. So if you could touch on, how you're finding these businesses, what the due diligence process, what it is you're looking for, I think that would be really interesting.
Yeah, how much time you got? I'll give you the short version.
Well, somewhat high level, and I know it's proprietary, so yeah.
No, we proprietary in the sense not that we like keeping it a secret, but rather that we just we built it ourselves to kind of do it for ourselves. But on the sourcing side, I think there's really two channels of kind of businesses, right? One is businesses that are already available for sale. And that what those are, they're kind of often listed by brokers. So, one of the first things we did just to start getting initial deal flow was to basically build a relationship with, hundreds of business brokers, and also get kind of the API feeds and the data feeds from every broker listing site. And what we do then is we, pull the data in. So instead of saying, hey, what most people do with broker listings will say, hey, they'll get an email, once a week with all the listings that, are filtered for them, and they'll kind of look through them and say, okay, this is an interesting one, this is an interesting one, let me call them. What we do is actually the minute a deal gets originated, we actually pull it into, pull the API, put it into a database that we have, and that database will then start basically trying to normalize some of the data. So it'll pull out, what's the revenue, what's the earnings, what's the region, how long has business been around, stuff that is usually somewhat standardized, and try to kind of, force rank the ones that we think are really good fit for us.
Nice. It's like a stock screener for private companies, basically.
Exactly. But then we go one level ahead, which is we have a team that's kind of offshore that's basically saying, the one question they have to answer every day is how much more information do I need to know about this business to put in an LOI, a letter of intent, which is a non-binding kind of indication of interest, at a certain valuation. So what they do there is they have their checklist. Here's everything I need. So if there's certain things that are missing, they'll basically go, reach out to the business owner, the business broker, and say, here's the 7 pieces of data I need before I can kind of get more data. So, they're always kind of completing the analysis of the pre-screen as businesses. So every time we look at a deal, we have every single one that we can compare apples to apples and say, these are the ones that really stand out based on, kind of valuation and things like that. Or, just, quality of reviews, or, revenue per employee, or whatever the metrics we're, using, which I'll use all of those. The second thing we do is we actually come up with our own internal evaluation, which is also somewhat digitized, which is basically we kind of say, look, the industry will value, HVAC companies at, 2.8x EBITDA. But it's a really kind of blunt instrument to use to value something, right? And it's what people use. But, what we said is if we can actually come up with our own valuation methodology that's more tied to how we truly value something, then we can find the ones that are, undervalued, because everyone else is using this kind of blunt instrument of a one multiple, right? So we kind of go and say, look, how long, we'll adjust the multiple based on, how long has business been around, how strong is the management team, what are the reviews, is this region growing quickly or slowly, what's the unemployment and things like that in the region, and how many big cities are nearby that can be expanded. Those are all things that we filter into to say our actual valuation is X. It's not 2.8, it might be 4, or it might be 2. And then what we do is we sort by the ones that are most undervalued and sort of prioritize those first, to kind of do some outreach to. That's kind of the high level. I'm happy to dig in further. Or
no, I mean, that makes sense. I think adjusting, you're right. I mean, it's a very crude measurement. It's 2.8 is a great multiple, but if the company has been operating for 20 years, it's in a high growth spot. They're the only HVAC person in town. They have all of these, they have a good moat and good projected earnings growth. It makes a lot more sense to pay up for that sort of business. So you had mentioned business broker sites. So I'm curious, are these Flippa, Empire Flippers? What other key business brokers?
On the digital side, you have, Flippa, Empire Flippers, Epi International. On the digital side, on the brick and mortar side, there's actually a little more consolidation in the sense that everyone actually uses one aggregator for the most part called BizBuySell. And BizBuySell is an aggregator where brokers actually advertise their listings. And what we actually do is, yes, we scrape the listings from those sites, but we then actually go out and have someone call all the brokers in regions that we care about or in industries that we care about and try to get that on their own proprietary lists as well. So they, oftentimes what they'll do is they'll circulate a deal to their network before they pay the listing fee to BizBuySell to list it. So oftentimes there's, I'd say like the BizBuySell is sort of the tip of the iceberg in terms of actual businesses that are available for sale. The other thing that often, it's kind of strange, you'd be surprised, but business brokers tend to turn down a lot of listings because they think they're going to be too much work to sell. And we like doing work, so we often say, hey, if certain things that you fit into our wheelhouse that you're rejecting even listing, please send them our way, and we'll still happily pay you, your commission. But just send stuff our way so we get a first look at it before you decide to pass on it or something.
Nice. So you're taking the ones that they even decline and running them through your analysis.
Exactly, right. And sometimes people decline because they're over capacity, or they're a broker that is in Boise and they don't want to go to another part of Idaho because for whatever reason, right? Or
right, they're human too. I mean, sometimes just life is in the way, right? So can't prioritize it. Awesome. Yeah, that's very, very fascinating. So I'm curious. Obviously, when buying a private company, there's a lot more risk than buying like a publicly traded company. So there's loads of them, right? So in your opinion, what are like the key risks or kind of icebergs that you're looking out for when buying these companies?
That's a great question. I think we really break it down into kind of 2 or 3 things that we can kind of understand, right? So the first one with a triple underline is really just kind of key employee risk, because at the end of the day, a business is a consortium of personalities that kind of meld together, right? And sometimes those personalities, there's certain individuals that are very, very important to a business, and oftentimes like an entire business process can be built around a person, or there can be a single human that does all the sales for the entire organization, or there's a single person that manages the license for a large organization. So what we really try to understand first is like, what are those single points of failure in the business? Those can be sort of legal, they can be licensing, they can be knowledge, they can be distribution, because someone is a member of the Lions Club or whatever, and that's where they get all the leads from, right? So like we really try to understand all those things, which are where does distribution come from, who's actually doing all the work. Like let's look at every revenue stream in the business and like try to map it out from end to end, and let's make sure that there's like some repetition on every single one of those things. And if there's not, then we either don't buy the business, or we during the period between analyzing business and closing the business, we try to build a repetition stream for that stream. The second thing is there's just a lot of legal issues that you don't think about, with respect to kind of, workman's compensation, data protection, how you're storing things, environmental issues, right? So what we really try to do is understand those needs on a state-by-state basis. Make sure that we insure against, like at the end of the day, the nice thing is like the insurance exists, right? For all these risks, you kind of know what your maximum liability is for the most part, because you can insure against workman's compensation, you can insure against environmental risks, you can insure against data leakage, whatever. We obviously try to do the right thing, but we also just make sure that we're well insured so that one event or item can't sort of destroy like everything else with collateral damage. So that's another thing that we spend a lot of time on. The third is the business just really being, and this is part of kind of key man risk, but it's like the biggest key man risk is sort of the business actually just really being operating in the owner's head and not anywhere else. Meaning they have knowledge that no one else has. They have systems that no one else has. So what
no really documentation.
That's the norm.
Good
right?
luck.
Like documentation is it's when you ask for documentation, they bust out the old employee manual from 1972 and be like, we haven't looked at this thing in 15 years, but here you go, right? So a lot of what we try to do is basically spend the first the first month before close and then the first month or two after close really just making sure we again understand everything that can be understood and try to systematize it, put it into software, put it into an ERP system, so that there can be some continuity.
Awesome. Yeah, good answer. Thank you. That key man risk, it's oh so important with these sorts of businesses. And I think that's what really spoke to me on your website is, you know, maybe if you could talk macro picture of why now, but you touched on some percentage of small businesses being owned by people
Mhm.
over the age of 60 looking to retire, all of these things. So I think, yeah, if you could just answer
Yeah, absolutely.
why now?
The why now is, I mean, I think there's just this big transition happening right now where many business owners, especially in the brick and mortar businesses, started them in the 60s, 70s, and 80s, and now they're really getting ready to retire. So 60% of business owners in the U.S. are over the age of 60. That's kind of like 2.3 million business owners, right, are that age. And there's a lot of things that go with that. So obviously many of them have built very successful businesses that are very financially successful. But when you're financially successful, you often just don't evolve, right? And that means many of these companies haven't evolved onto using new technology, onto getting away from 3-page carbon paper to do their invoices. They say, hey, it's worked and I've gotten successful using it, so why change?
And the
The second,
margin expansion associated with just optimizing a few of these things have got to be insane.
well, what we find very almost it's almost like these things kind of rhyme, right? All these like successful businesses rhyme in the sense that there's a lot of things that are very similar. They've always had a culture of providing very, very good service, but because they do everything themselves, that's why they provide good service. But what that means is they can't scale because at the bottlenecks and the owner at the end of the day who's writing the invoices by hand and checking jobs by hand, right? So that's something you can't double your business. So they often, these companies turn down 30, 40, 50% of the calls they get because they just don't want, they can't scale, they can't train people, they don't trust anyone else. And so that's kind of one thing. But to your bigger question, which is why now, even especially with COVID, I think what a lot of people are seeing is that, hey, I'm in my 60s, I kind of want to spend time with my family. I don't want to actually go out and put myself at risk of getting ill, especially when I'm a high risk person, becoming elderly. So there's a big transition with a lot of these people that said, I'm going to retire in 2025, or like, I want to retire now, right? I need to get out of this business now, so I can kind of stay home with the kids and family, move to my mountain house, whatever it is. And historically, what had happened was, if you look at like the last 100 years, these kind of trade companies, the businesses were passed down to children, right? So it was like, okay, well, my son's going to take over the plumbing business and he's going to be a plumber. But if you look at what happened in the 80s and 90s, all these people were like, go to college, get your degree, go study liberal arts, go work in a big city. So many times, like these guys will own businesses, will own businesses, and their kids are engineers at Facebook, or they're attorneys, and they're not going to come back to Middletown, Colorado, and run a plumbing business, even though it makes a lot of money. It's just not their lifestyle. It's not how they're kind of their lives right now. So there's really just this gap where there's not really anyone to take these businesses over, because people that know how to run them, the plumbers and technicians, often don't have the capital, the financial sophistication. And the people that have the capital and financial sophistication are working on Wall Street or working in corporate finance. So it's kind of this big gap. And that's kind of one of the things that we're really trying to fill as an organization, is that gap between capital sophistication and technical know-how and kind of and service culture. So, and a willingness to kind of be in regions that might be very lucrative, but that might not be the most appealing for a business owner. It's not on the beach in Florida or something.
Yeah, and that really makes sense, but it begs the question. I mean, eventually you're going to have to staff these businesses when the business owner leaves. So even if obviously it won't go to their children, but I would imagine that hiring for these sorts of technical positions is got to be very difficult right now. And so obviously that's part of the value add that you at Kingmakers Ops is adding.
Yeah,
but
100%.
Is that a gigantic hurdle for you guys?
It is really important, but I wouldn't call it a hurdle. So it's very important to get the right people in the right seats. I think there's certain ways that we think about it that are maybe a little different than how other people think about it. So one, I think the question is, labor is a competitive market. So the question is, who are you competing against, right? And generally speaking, who we're competing against for technicians are old mom and pops that refuse to bring an iPhone to work and use carbon paper, or private equity owned organizations that are really, really focused on the bottom line and on upselling and on, charging the most you can on an individual sale. And that's like the norm, right? So, it's really funny because you can actually just do a cursory look one day and say, look, let me look at the Yelp reviews, the Google reviews of a private equity owned auto mechanic or private equity owned plumber versus one that's owned by a hands-on technician, and the reviews are going to be night and day. It's like 2 stars for the private equity ones because they don't, all they care about is profits often. Like that. I mean, it's a generalization, but it's one that we've seen that it's kind of somewhat accurate. Versus the ones that are technician run that really care and provide good service. So what we're really trying to do is meld those two things, and people don't really see those opportunities very well. The second thing is, I think that the question ends up being, what is a technician worth to you? And are you actually paying that value for a technician? And usually it's not, right? Like, it's like, okay, well, I paid $16 last year an hour, so I'm going to pay $17 this year an hour, and I can't find anyone. And when you're saying I'm making like $300 an hour off this person, why don't I pay 20? Like, the leap that you need to make in order to really just kind of think a little bigger picture. And, you pay a little more, you offer 401k benefits, or, pay for, night school, or add on education, provide a couple extra days of vacation. Those things are not that expensive in the grand scheme of the business, but they add a lot. They're very important to people that come to work every day. So that's kind of the one holistic thing about just the numbers. And to your second point was location. And, I think what we really try to learn from with location is, I think there's a lot of organizations globally that make living in some weird place a badge of honor. And I'm just going to a weird place, a place that may not be in favor, right? Not living in a big city, they make it a badge of honor. So using organizations like the Peace Corps or Teach for America, or, the military, right? Where you're like, okay, well, I'm stationed here, or I went to, XYZ town for a year and it was great, right? And what we're really trying to do is make it a cultural thing where we train people and say, we kind of have this ascension model where we try to bring technicians in early that are highly qualified and say, look, we'd love you to come, be a part of the Kingmakers Ops organization so that in 4 or 5 years, we can actually help you become a business owner yourself. And that's the goal that many people want to have. And we'll say we'll provide mentorship and training, but here's the other side of the bargain. You're going to have to live in, I don't want to disparage these. I mean, some town that people may not want to live in, right?
From Indiana, just use that one, small town in Indiana.
Small town in Illinois, but you get the idea, right? So we're like, hey, here's the first step is like, you come work here, you crush it on this business for the first 3 years. And then when you hire your replacement that you think is as good as you, then we'll let you move on to the next thing, which could be buying a business. It could be being a manager of a region. So that's kind of, we're trying to build this ascension path and badge of honor of living in places that are not traditionally appealing.
Yeah, that's really interesting. I think it'll be very, very fascinating to watch you guys expand and grow. I'm curious, like right when you go into a company, what is the initial, like the first biggest lever you can pull that can move the business the most?
Oh man, I hate saying this, but it's raising prices. It's an easy one. People tend to underprice. Like, people that provide good service tend to underprice. It's just a weird thing. Craftsmen often just say, I don't know how much to charge. So that's when we bought a business, a year ago, we found that they were, by far they're the best service of any company in the region. And they were, underpricing by 15-20% compared to everyone, which is why their phones were ringing off the hook, and they couldn't service like half the people that called them because they just didn't have the manpower, or didn't want to expand because the owners were getting ready to retire. There's certain digital marketing levers associated with increasing your conversion rate on your best channels. So, let's use, some people's best channel could be Yelp, other people's it could be Google organic, other ones could be Google reviews, but let's just use Yelp as an example. So if you're getting 30% of your customers from Yelp, then what can you actually do to work with a Yelp or an optimization expert to optimize that profile so you get more conversions from the same amount of traffic? So that could mean changing your ad copy around, highlighting certain reviews, becoming a verified business, adding more appealing pictures, responding in 10 minutes versus 2 hours to quotes when they come in. Like, those certain things of really optimizing the inbound on any channel that's already working. So it's kind of like, the first thing we'll do when we come to a business is just sit there and watch for a period of time. Well, as we're watching, there's certain things that we can do that are not disruptive. It's not like, hey, all of a sudden, I know you guys were using paper. Here's an iPad. Please go to work now, right? It's more about, hey, you were getting leads from Yelp. Let's just make the leads better. Let's try to maximize the revenue per lead and certain things like that.
Well, and I would think with this niche of businesses, I mean, might be a broad generalization, but I wouldn't imagine that they're as digitally savvy as they can. And like the low hanging fruit there, is just, have you ever tried paid media, paid advertising? Here you go.
Well, many people, they use conjecture instead of data, right? So they say, I tried the Yelp ones, and there's some guy called me and I didn't like the tone he used, so I'm not using those guys. They're crooks, right? Or there's 3 leads we bought this one time, they didn't work, so screw this channel, right? Like that's usually the conjecture they tend to use versus saying, hey, here's my revenue per call, here's my profit per call, here's my cost, here's the percentage conversion rate, which is the data you should sort of be using, right? And even the people that when you do hire marketers that focus on local, right? I think oftentimes it's if you're a really good marketer, I think you're often more inclined to want to go work for a digital business that's highly scalable, and less inclined to want to work for I'll use middle of Indiana, plumbing.
Absolutely.
Again, right?
Yeah.
So that's a certain thing as well, where we try to bring a level of sophistication, talent, and just systemization to every part of the process, including marketing, which is a very big lever.
Well, and this is where, I mean, so again, broad generalization, but I would imagine it's this little mom and pop HVAC. I guess they're quite bigger. They're bigger than that, but
they're often big mom and pops, right? It's kind of
right.
like, hey, we're mom and pop, but all of a sudden we found a niche, and we're a mom and pop that do 5 million a year in revenue and $1 million in EBITDA, right?
Right, because they're like the ideal customer avatar for this. I mean, what kind of EBITDA revenue? Yeah.
It's weird. Again, you start seeing trends just everywhere where, I think we see a lot of companies that kind of cap out right at or around about $1 million in earnings. So if we go back to what's revenue on that, well, the margins are 20 to 30%. So the revenue is $3 to $4 million. The profits around $1 million, upped up by 25%, shrink by 25%. That's kind of that range where, we find companies that are still a little too small for private equity, like big private equity firms, because they don't have the CEO and the CFO and all that stuff in place. Like usually if you're a PE firm, you're going to want a company that has a management team, right? And we're sort of willing to do that work of putting the management team in and earning that outsized multiple, because, usually if you have a management team in and you have a great business and you find product market fit, you're not going to be a $1 million business. You're going to be like a $4 million business. And it's really just, making sure that, supply and demand meet with high quality service, right? If you have that, your $1 million business is probably a $4 million business, and your 2.5x EBITDA multiple is probably like an 8x EBITDA multiple, because that's what private equity tends to pay. So we try to kind of we're young, we're early, we're learning the space, so we'll kind of be the value players, and we'll kind of go a little lower end to and not lower end, but we'll do the heavy lifting a little more than a sophisticated private equity firm might, to get sort of those wins, and then eventually if we choose to sell the business, we can sell it at sort of in that way, right? So,
you touched on a few things that makes me think about exits here. So it sounds like you buy $1 million per year, you grow it by a couple, some optimizations, grow the revenue, whatever, and then kind of targeting a 8x multiple exit. But my question is more, one, correct me if I'm wrong there, and then 2, will you aggregate these and then almost like a franchise sort of, this one in northern Indiana is all the HVAC, and you're going to put in a head office that takes care of all of these, and it's then group that as like a portfolio, and then spin off that new company of these aggregated smaller businesses to a private equity, because then that would be a little bit more in their range of purchasable assets, right?
Yeah, absolutely. I mean, I think we're taking everything in baby steps. Yes, I think that the goal is and will be to create a more consolidated portfolio that's a roll up, that has a unified brand. There's certain steps we're taking in that direction today that make it much easier for us to do that when we choose to do it. So we try to use the same sort of software tools and management systems and ERPs across all of our companies, so that there's not a lot of transition, not a lot of switching costs. So we said we don't want to do it later. The second thing is we are trying to identify those services within that should be shared services, and are building that infrastructure gradually. So, there's certain points of pain for every home services owner. And, a really big one is after hours calls. There's not a great way to do, 'cause usually the owner will pick up calls at, after 6 p.m. There may not be a lot, but it still sucks that, being, the 10 p.m. being roused out of, having drinks with your friends, or being called at 2 a.m. It doesn't happen all the time. It still sucks. So, what we're trying to do is find a really systematic way to manage that. And then as that process gets built, we'll kind of extend that to the other companies in the portfolio. Things like bookkeeping are already pretty well extended. Things like marketing are already pretty well, systematized. But we're kind of gradually do those things. And then what will end up being the head office is that vehicle that does all the shared services across all the other organizations anyway. So it's not like it's more of a gradual change. Like, we don't like changing things like dramatically on day one. It's just like, we kind of like, watching and understanding before we sort of like declarations of what should be done. So, all of a sudden, here's your new uniform. It's like the Kingmakers red, right? We try not to do that much of that stuff. So.
Oh, yeah. Well, your integration team will have fun. I know a lot of these businesses have been operating with the systems that they have, and integrating new systems like an ERP can be very difficult. Absolutely. And lengthy, for sure.
Well, yeah. I mean, one of the things that we learned there is we really try to get people, the key managers that already have the trust of the organization, like the lead ex-technician, right? We try to get them bought in by brute force is probably the right word, right? You just make them watch a lot of videos and sit there and, wouldn't it be great if you could do this? Wouldn't it be great if you could do this, right? And you get them bought in, and once they buy in, then and they're the ones convincing their team, not the new, high-fluent owners, whatever, right? Like it's a much more straightforward process of getting everyone else on board.
Okay, makes sense. So, in your opinion, as one of the co-founders, I mean, what's the biggest risk with this sort of business model? Is it the assumption that you'll be able to sell this portfolio later, or you're buying them for cash flow and you can hold them into perpetuity and it'll be okay?
No, we're definitely buying for cash flow. So, I think we're only doing deals that we think are profitable. They're be cash generative. So the exit is really the cherry on top, not the cake. I think we like this business model. I think we like the industries we're in. If we're holding this for a decade, like I'd be delighted. Like I think that it's just, I think these businesses can thrive and become more valuable, over time. So I think the risk is more around, unifying the training and management and trying to manage the managers or manage the portfolio. That had always been the challenge, the digital side, and I don't see that it not being a challenge. I mean, we definitely learned a lot of things since then that we implemented, but I think to me that's the thing that still keeps me up is how do I, sort of manage this thing more so than how do I sell it, or how do I buy businesses, or how do I grow it? Those things are, I think we've dialed that in reasonably well.
Yeah, well, it's certainly not going to be easy, but I'm a big fan of buying these cash flow producing private assets at a decent multiple. I mean, everything has been bid up just beyond belief. So if you can actually find something that's 2-3 times EBITDA, I mean, it seems rather resistant to economic shocks. So good business to be in. So shifting a little bit more to Kingmakers Ops, the crowd fund right now. So right now you're raising on WeFunder. You've raised $432K out of 1.07 million, I think, right?
Yeah.
So yeah, if you just talk a little bit about what you're getting as an investor, what the timeline is, and just anything you can share on that.
Sure, absolutely. So, we're kind of raising at the moment really just to, again, I think, platforms like WeFunder are a fantastic place to kind of shout out to the world, especially people that are investors, that, hey, it's not all about, startups and software and AI. There's some great businesses out there that actually drive great returns. For the $1 million, we're selling, 15-ish% of the company, 15.3. It's a $7 million pre-money valuation, and we're raising $1 million on that. on top of that, I think the other thing we're really trying to do is really activate that community. So, at the moment, I think the average investor has invested like $200, $250 into the campaign just because they kind of want to watch what we're doing, or they want to diversify their investments. But, what we have now is, 1,300 people all across the country that are supporters of Kingmakers. And, one of the things we plan on activating really aggressively as the campaign ends is to say, hey, do you have any friends, cousins, neighbors that own brick and mortar businesses that may be interested in selling? Do you have...
Chances are they do.
Yeah, chances are they do. We've already gotten, 40-ish leads from people, as we've even just casually mentioned it. Do you have, nieces, nephews, kids that may want to, join the management program, right? Or do they have people that are in trade schools already that may want to, kind of work with us if they want a job? So we just kind of we always see the benefits of having a big community, and people that have actually kind of committed capital to you are like the biggest supporters of what you're doing. And so that's kind of the reason we're on WeFunder versus going to, kind of more traditional, venture funding or private equity funding routes. Is, we have and will do that. But, I think the other thing is our business model actually is oddly, surprisingly cash efficient. Generally speaking, you can get, 80 or 90% debt financing on these businesses. So, $1 million can actually buy you, 5 companies that make, $4 or $5 million a year in cash flow, at which point we can kind of virtually continue the cycle by using cash flow to continue to buy businesses. So, WeFunder's been a fantastic platform so far for us, and everyone's been very supportive.
Awesome. Yeah, and it looks like you're 430K. You said about a third of the way done. So raised 40% and a third of the way done. What happens if you don't hit that cap of $1 million? I mean, is this a hard cap, or you can operate with this amount?
Yeah, absolutely. So I think the way that WeFunder is structured, that there's a floor and a ceiling. The floor, I think we had was, $50,000 or $100,000. So we've already hit that floor. So, that capital is ours to kind of invest. The hard cap is actually a legal hard cap by the SEC of $1 million when you sell to unaccredited investors. So that's kind of where we are. I think what we have today is 430 should be enough to, close 2 acquisitions, and there's not really a reason for us to stop. Like, we can kind of pause the capital as we choose to or need to, and then, eventually come back in October once we've kind of, doubled our business, cross fingers, right? Done really well with the initial acquisitions, and kind of go out that way, or continue to raise more. So it's really not like a one-time thing. It's really just I think it's like a running process for us to always, identify people that are interested in doing what we're doing, participating by investing, and also following along with kind of the updates and things like that we provide.
Is this the only fundraise that you're doing, or are you doing a private round in parallel to this?
At the moment, this is the only round we're doing for Kingmakers Ops. Frankly, that the money's just going to sit there for a while. So, it's one of those things where you don't want to raise more capital than you need to sit there. The deals we have kind of under LOI, the capital that we've already kind of gotten committed is sufficient for that. It's going to be it'll be some time to digest that, those businesses, right, and to do a good job of kind of systematizing them. And at that point, I think we'll decide, if the right approach is to go raise more equity capital or go raise debt capital, which, both of which are options.
Makes sense. So Kingmakers Ops, is there another company that's following a very similar process as you? Anything publicly traded that I could compare it to?
Publicly traded, not as much. I mean, I think there's a really interesting roll-up of, chiropractic clinics called The Joint, which is neat. I always like watching them. I think on the digital side, there's a lot of really, really great examples of companies we follow and have learned a ton from. Constellation Software is like a $50 billion roll of software companies that's public. The majority of the, home services, brick and mortar style businesses, oddly, the public ones have all kind of shifted to lead generation. But there's a lot of great private companies. So, Wrench Group is a company that's owned by private equity that, does roll-ups of HVAC businesses, and mostly in the southeastern U.S. So I think they're very interesting. We definitely watch what they do. There's definitely, some other, kind of roll-ups. What's one I think of. There's a venture funded company called, I think it's called Team Shares, which basically is kind of helping solve this problem for retiring business owners and saying, hey, we'll buy your business and over time we'll kind of give shares and empower your team to run it. So, I think there's definitely some noise in the space, though. We're the only ones that we kind of know doing exactly what we're doing, but I think we just think we're a unicorn, so that's why.
Awesome. Team Shares. I'll definitely check it out, and I'll link all of these things in the show notes, and I'll link to the WeFunder campaign for Kingmakers Ops for sure. So last thing for my listeners, where can they find out more? Any closing words, thoughts on Kingmakers?
Sure. So you can visit us at kingmakers.co. We to learn more about the business. The only thing I'd say is if you're really kind of I kind of fell into this path of buying business because I was kind of frustrated with the corporate life, and even though it was because you want to work in private equity, and I think a lot of the team members on our team had the day job and kind of gone to school and kind of gotten the job that they sat in cube all day, and they've found a ton of satisfaction from buying a brick and mortar business. It's one of those things where you're kind of like, hey, I want to do a startup, but I'm not sure why, or I don't have a great idea. Definitely consider buying a brick and mortar style business. I think it can be pretty rewarding, both kind of financially and just professionally in terms of how you spend your day. So that's certainly why we're here, is because we think it's a great opportunity.
Awesome. And actually, I had one more question. So the type of person that should invest in Kingmakers Ops via WeFunder, like time horizon, who's your ideal investor? What do they look like? How do they earn back their investment or more?
Sure. Absolutely. So, I think there's definitely a small bite size, right? It's I think the minimum investment is $100. We made that intentional just to let more people participate, but, definitely don't invest if it's your last $100. But if you have you've considered making angel investments in the past, either through a crowdfunding site or directly, or, a large portfolio of public companies that you think might be a little overvalued, investing in an affordable, profitable, network of businesses, I think could certainly be interesting for a lot of people. On the exit side, I would say, I'd like to say, in 5-ish years, that the goal would be to, kind of take the portfolio public or sell it. In the meantime, it will very likely pay out dividends, over that time. With our last kind of roll up, we were paying out, 20 or 30% a year returns. With Kingmakers Inc, it's kind of been closer to 10% a year, so we're reinvesting capital quickly. But if you like, potential high dividends, kind of value plays, things like that, I think it definitely could be a good fit.
Awesome. Yeah, I think that's something that will resonate very well. Awesome, Deven. Really appreciate you taking the time and jumping on today.
Absolutely. Well, thank you for having me, Ben.
Yeah, thank you.
There you have it. Thank you for listening. I really appreciate your support. Show notes, transcript, links, and more can be found on our website at altassetallocation.com. If you'd be so kind, please share this with anyone you think might be interested or get some value from this conversation. If you have any questions or comments, please reach out. I'm always happy to hear them. Lastly, if you're on YouTube, please like the video or subscribe to the channel. If you're listening to the audio version of this, please subscribe to the podcast and or leave a review. This really helps more people find the podcast, and I really appreciate it. Thanks again, and hope you have a fantastic day. Happy investing.